Okay, so if you thought last week's market drama was enough, with the Federal Reserve delivering that rate cut well, wait till you see Powell, TikTok, and crypto walk into a bar.
Yeah. Yeah. Rough.
Seriously. We're looking at a market week where monetary policy, massive geopolitics, and just pure unfiltered leverage risk didn't just converge. They pretty much collided head on, like in a chaotic 48-hour window.
It really was a truly kinetic start,
Mm.
putting pretty much every major asset class under pressure or, sending it soaring, and on completely different yet equally significant pieces of news.
Exactly.
Staying informed this week, it really means understanding not just what happened, but maybe more importantly, how these disparate forces interact.
Absolutely. So, okay, what's the mission for this deep dive? For you listening, we are going to unpack 3 immediate market movers, things that are frankly critical for you to navigate the week ahead. First, we're decoding the Fed's messaging, what Chair Powell and a key new governor are saying just after that pivotal rate cut, and maybe why the market seems to be running ahead of the actual data.
Okay, 10 second.
Second, we pivot into, well, the fascinating, maybe slightly terrifying world of corporate geopolitical entanglement. We'll be analyzing that deal positioning oracle. Yes, oracle,
Yeah.
as the unlikely, maybe even unwilling gatekeepers for TikTok's, hugely valuable U.S. algorithm.
Yeah, that's a big one. We definitely have to ask if that whole deal is basically built on a technical loophole, one that might not even survive scrutiny.
Good point. And finally, we absolutely have to talk about the brutal reality check delivered to the digital asset world. That sudden, violent $1.5 billion liquidation wipeout that just slammed the crypto markets on Monday.
Oof. Yeah.
We'll break down the specific technical signals like the funding rate that indicate a really profound shift in market dominance there.
So our goal here is really to connect these threads, help you stay nimble, and I think most importantly, make sure you don't just chase the momentum without understanding the underlying risks, especially given the, unprecedented market euphoria we literally just witnessed.
Right. Where do we start?
Let's dive right into the heart of the action, the Federal Reserve.
Okay, let's unpack this. A really high-stakes week for the Fed. We just had that quarter-point rate cut last week, a move that was, heavily anticipated, yet the market reaction that followed, it was far from boring. It was, frankly, explosive.
Explosive is definitely the right word.
Yeah.
We didn't just see like 1 or 2 indexes hit records. We saw structural market-wide euphoria. On Thursday alone, we witnessed the S&P 500, the NASDAQ, the Dow, and the small-cap Russell 2000.
Yeah.
All closing at record highs in unison.
Wow. All 4.
All 4. That kind of alignment, across growth, mega cap, tech, value, small caps, it just hasn't happened since 2021.
Right.
And then, just to kind of cement the mood, the 3 major indexes, excluding the Russell, closed at yet another record on Friday. The market isn't just hot, it's like convinced.
And that conviction, it translated directly into massive money flows, didn't it? When we look at the hard data, the market didn't just, cheer the cut. They put their cash where their cheers were.
Absolutely. Inflows to U.S. stocks tallied, get this, a staggering $57.7 billion for the week.
$57.7 billion. Yeah.
And here's maybe the more critical data point, the one that tells you about the true investor psychology right now. Investors moved nearly $5 billion out of cash holding.
Out of cash, okay.
Think about that. That marks the first weekly outflow from cash since way back in July.
So what did that signal?
It signals that the consensus view is shifting, moving away from, fear and cautious reserve toward the profound fear of missing out. FOMO.
Ah, FOMO, right.
Investors seem to believe the Fed is committed to easing and that cash just sitting on the sidelines is, losing potential returns.
But, okay, the Fed is not done talking. This is where the market complacency maybe meets reality, right? We have Federal Reserve Board Governor Stephen Mirren scheduled to speak on Monday, followed closely by the main event, Fed Chair Jay Powell on Tuesday. Now, we've joked before about Powell's karaoke, suggesting he just sings the tune the market wants to hear.
Right, yeah.
But if that 2.9% inflation number holds, is he truly risking his credibility by not being a bit more hawkish now? Or at least cautious?
That is the absolute central tension this week. The market has priced in smooth sailing, multiple cuts, maybe 3, even 4 by the end of the year.
Right.
But Powell has to speak from the data, not from market sentiment, Traders are hanging on every single syllable he utters, desperately seeking hints on really 3 specific policy elements.
Okay, what are they?
First is forward guidance. Any clues on the pace of future cuts. Second, any commentary on the balance sheet adjustment process, quantitative tightening or QT. And third, whether he specifies a new, maybe lower inflation threshold that would trigger more aggressive easing.
And we've definitely seen the market react sometimes violently to unscripted Powell comments before. If he sounds even remotely cautious, emphasizing that data-dependent nature of policy, especially against inflation, that euphoria could just poof, evaporate instantly.
Exactly, because that data, it's arriving at the end of the week. The key release everyone is watching is Friday's update on inflation, the personal consumption expenditures, or PCE index.
PCE, that's the Fed's preferred one, right?
That's the one. Their truly preferred measure. And unlike CPI, it's much harder for them to just ignore or explain away.
So what's the consensus expectation? What are people predicting?
Well, the expectation is that core PCE inflation, so that strips out the volatile food and energy costs, will have eased slightly, maybe to 0.2% in August month over month.
Okay, that sounds positive.
It would be, a little bit. However, the annual increase is projected to remain stubbornly stuck at 2.9%.
2.9%, still. And while that's closer to the Fed's target than, say, where we were a year ago, 2.9% is still materially above the central bank's stated goal of 2%. It keeps inflation persistent, not quite solved.
So, okay, we've got a clear disconnect here. The market's basically pricing in like 100% certainty that the Fed achieves its target, no problem. But the actual data coming Friday could remind everyone that inflation is still, well, a persistent problem.
Precisely.
And this tension, it makes Powell's Tuesday appearance just fraught with risk.
It absolutely does. And we also have the University of Michigan's Consumer Sentiment Index on Friday. That gives us a broader gauge of, economic confidence.
Right. How does that play in?
Well, if that sentiment index comes in strong, it suggests the consumer is robust, spending is likely to remain steady, which in turn gives the Fed less justification to cut rates aggressively.
Because the economy doesn't need the stimulus.
Exactly. It implies the economy doesn't need that much help to avoid a downturn, and high confidence could mean potentially sustained inflation pressure down the line. Okay, so wrapping this Fed segment up, what does this all mean for you, the listener, trying to navigate this high valuation environment? Given the record highs, the incoming Fed speak, that looming inflation data, what's the advice?
Yeah, the best advice right now seems to be stay cautiously engaged.
Cautiously engaged. Okay.
If you are trading actively, now is probably the time to respect the volatility. Keep those trades light.
Light sizing. Makes sense.
Specifically, maybe consider structured hedging strategies. That might mean buying protective puts on index ETFs like SPY or QQQ, or maybe utilizing option spreads to define your risk clearly.
Defined risk.
The market has priced in a lot of certainty, a lot of good news. But if Powell hints at caution, or if that 2.9% inflation number proves sticky, we could see a pretty quick reversal, fueled by profit-taking. You just need to respect that high volatility, especially when you see money flowing out of cash and into risk assets at this kind of speed.
Yeah, it feels like it's all about defense right now, even when the offense seems unstoppable. The trade risks related to U.S.-China tensions had maybe subsided a little, giving markets a lift. But now, all focus is right back squarely on domestic monetary policy and whether this record-breaking party can actually continue without a hiccup.
That's the billion-dollar question. Or maybe trillion-dollar at this point.
All right, speaking of those geopolitical risks, maybe easing slightly, let's pivot. Let's move from the Fed's monetary chessboard to a technology deal, one that is massively complex and caused a sudden, pretty surprising surge in a very unlikely stock. I'm talking about the arrangements surrounding TikTok's U.S. operations.
Yeah, TikTok.
Yeah.
This issue has been, a political and security nightmare for years now, hasn't it?
It really has.
Driven largely by the Trump administration's firm push for a full sale, or at least a divestiture to American investors, all due to security concerns over the Chinese parent company, ByteDance Ltd.
Right. And U.S. law, it mandates that ByteDance must have no operational role, particularly with that recommendation software, the algorithm that basically drives the entire platform.
That's the core issue. And here's where it gets really interesting, as you said, because the surprising partner stepping in to serve as the technical firewall, it's Oracle Core, ticker ORCL.
Oracle. I mean, they're known for enterprise databases, cloud infrastructure, not really managing the algorithm of a hyper-volatile, global social media giant.
Exactly. And the market reaction, it pretty much confirmed the surprise. Oracle stock jumped a sharp 4.06% just on the news of its, well, highly unusual and pretty crucial involvement.
So what is their involvement? What's the plan?
Oracle is set to become the technical backbone, basically, the security partner tasked with managing U.S. operations.
And the core task assigned to Oracle is, well, it sounds mind-bogglingly complex. They are going to recreate and provide security for a new U.S. version of TikTok's algorithm.
That's the language used, yeah.
Mm-hmm.
According to the source material we have, the U.S. owners would essentially lease a copy of the algorithm from ByteDance.
Lease it. Okay.
And Oracle would then be tasked with retraining it from the ground up.
Retraining it from the ground up. Okay, that phrase sounds critical. And maybe, like you said, the source of immense legal and technical controversy.
Absolutely.
Hmm.
The algorithm, the recommendation engine, that's the crown jewel of TikTok. It's the sensitive tech that knows exactly what video to serve you next to keep you glued to the screen, maximize engagement.
Right.
It's fundamentally based on analyzing billions and billions of user interactions.
So if they are only leasing a copy and then retraining it, what does that technical process actually involve? It can't be as simple as just changing a few lines of code, surely.
Oh, not at all. No. It requires immense computational power, a deep, deep understanding of machine learning models. The process of retraining a recommendation engine like this involves feeding it localized U.S. data specifically, then removing any potential backdoors or, surveillance codes, and ensuring the input data isn't being manipulated by foreign actors. The promise, the core promise, is that all U.S. user data would be stored exclusively in a secure cloud, managed entirely by Oracle, with really stringent controls established to keep out foreign adversaries, specifically China.
Okay. And the official statement, I saw that, it really cemented Oracle's role as the U.S. security partner. It said they will operate, retrain, and continuously monitor the U.S. algorithm to ensure content is free from improper manipulation or surveillance. That sounds less like a software contract and more like a permanent security audit, like for a nation-state level threat.
It is. It's a massive technical and political undertaking.
Right.
But here's the challenge. Here's where the real friction in this dialogue comes in. U.S. law, as we said, mandates full divestiture, forbidding ByteDance from any operational role. Right. Yet Chinese law explicitly bars the export of such sensitive technology, especially core AI algorithms like this.
Wait a second. If Chinese law explicitly forbids exporting the technology, and Oracle is just retraining a leased copy of the algorithm, isn't this entire deal fundamentally relying on a kind of loophole?
That's the million-dollar question.
Like the idea that the retrained version somehow constitutes a new U.S. algorithm, even if the foundational intellectual property, the core logic, still remains with ByteDance.
Precisely. And you can bet that many U.S. lawmakers who back that qualified divestiture bill, they're going to see this lease and retrain model as, well, a regulatory fig leaf, at best.
They wanted a clean break?
Yeah, exactly. They want a clean break. The fact that the foundational IP is still ultimately controlled by ByteDance and protected by Chinese law means that a true clean divestiture might actually be impossible. Oracle is essentially taking on this massive political risk. They're betting that this retraining process will be deemed sufficient by all the relevant U.S. security and regulatory bodies.
And that technical viability is just paramount, isn't it? I mean, can you truly separate the recommendation engine from the core data flow in a way that guarantees zero backdoors? Or is this just signing up for a massive, ongoing, multi-billion-dollar headache for Oracle?
It could be.
What does a database giant really gain by becoming the security audit layer for a highly volatile social media platform? Is the contract reward truly worth the regulatory headache and the technical risk?
Well, the reward must be substantial, presumably in terms of cloud services fees, maybe future government-related security contracts down the line, prestige perhaps.
Okay.
But the risks are immense. If U.S. lawmakers veto this arrangement, which they absolutely still could, Oracle has invested time, resources, and frankly, reputation into a deal that just collapses.
Right. So from an investment angle, this is crucial. Is Oracle suddenly like a social media gatekeeper? Is that a new investment thesis?
Well, short-term traders are definitely playing the momentum. That 4.06% jump proves people see, dollar signs in the headlines right now.
Sure.
But long-term investors, they really need to look past the hype. Wait for proof of the underlying fundamentals. We need to see sustained profitable growth actually derived from this new role.
Is it repeatable?
Exactly. Is this a profitable, repeatable business model for Oracle? Or is it just a one-off political necessity that's going to require endless oversight and technical risk mitigation?
Yeah. This whole scenario, it just really underscores how tightly technology, national security, and intellectual property are intertwined now, creating just unprecedented market volatility based purely on political maneuvering.
It's a whole new ballgame. Yeah. Okay, now let's turn our attention to the market that always reminds us, often painfully, about the dangers of intertwined risk and reward, the crypto space.
Yes.
Because this week, gravity made a brutal and pretty shocking return.
Shockwave feels like an understatement here. We're talking about the largest leverage cleansing event since
March since.
Yeah.
At least March 27th, yeah.
Yeah.
More than $1.5 billion with a B. And bullish wagers were liquidated across cryptocurrencies just on Monday morning.
1.5 billion. That number is just staggering.
It really is. And it was the biggest wave of liquidations we've seen in months. You know, for all the talk about defying gravity and new market structures, crypto traders just learned the hard way that leverage always multiplies the speed of pain.
Yeah. Guess gravity still works, even in the metaverse, huh?
Apparently so, yeah. The damage was extensive, and it really targeted the highly leveraged tokens, Ether, for example, which has been a major focus for traders, due to its tech upgrades, institutional interest.
Right. The merge staking.
Exactly. ETH fell as much as 9%, plunging down to $4,075. And we saw nearly $500 million of leveraged long positions, margin called, on Ether alone.
Wow. So $500 million just vanished because traders were betting on prices going up using borrowed money?
Vanished.
Yeah.
Just like that. Even Bitcoin, the sort of anchor of the market, which has been relatively stable. It briefly dipped under $112,000. Though, to be fair, it remains within its established range, roughly $110,100 to $120,000, where it's been since early July.
But the human toll you mentioned. Over 407,000 traders saw positions liquidated in a single 24-hour period.
407,000. It's immense. Hard to even fathom that scale.
Yeah.
And the sheer scale of the sell-off, it dragged the overall digital asset market size back below $4 trillion.
Okay, so what was the root cause? Was it just retail panic or something deeper?
Well, you have to look deeper than just retail panic, I think. You have to look at the institutional momentum drivers, the things that have been pushing prices up that maybe started to fade.
Right. What was driving that momentum back in August before this crash? We often hear about institutional inflows, but you mentioned a specific trade driving supply dynamics, the DAT trade.
Exactly, the DAT trade stands for Digital Asset Treasury.
Okay.
This refers to the strategy where publicly listed corporations, like Michael Saylor's strategy or Japan's Metaplanet Inc., use their corporate treasuries to hold large quantities of digital assets, primarily Bitcoin, sometimes Ether.
Right. Strategy holds a ton of Bitcoin.
A ton. And this fundamentally altered Bitcoin supply dynamics. They were essentially hoarding tokens, reducing the available liquid supply out there, which naturally pushed prices higher.
So their buying kind of created the upward momentum, which then maybe led to the subsequent over-leveraging by other players?
That's a big part of it, yes.
Yeah.
They helped drive Bitcoin and Ether to those all-time highs back in August by continuously acquiring and just holding tokens. Ordling, as they say.
Ordling, right.
But as the market consolidated, reached these really high levels, the shares of those D-trade firms started to retreat a bit. Once their acquisition momentum slowed down, that underlying buying pressure just wasn't there anymore, which led experts to start voicing concerns that the market needed a serious breather, noting that, quote, no more meaningful inflows tied specifically to the day trade were immediately on the horizon.
So the market got complacent, too leveraged, betting the August rally would just go on forever.
Pretty much sums it up. Yeah, they got complacent, way too leveraged.
And now we have a clear technical indicator confirming this bearish shift, right? One that points directly to the dominance of short sellers now, the funding rate.
Yes. This is a crucial technical deep dive for you, the learner, to understand.
Yeah.
The funding rate. It's basically the periodic payment exchange between traders holding leveraged positions in those perpetual futures markets.
Okay. So how does it work?
Well, if the funding rate is positive, it means the bulls are paying the shorts, the bears, to hold their position open. That indicates bullish dominance. Lots of people betting on prices going up.
Okay. And what happened this week?
It turned sharply negative.
Negative. Okay, that's bad for longs.
Very bad. The funding rate hit its lowest level since the chaotic unwind of the yen carry trade last year.
Wow. Lowest since the yen carry trade unwind. That sounds significant.
It is. A negative funding rate signals a huge reversal. It means short sellers are now dominating the market. And the leveraged long positions, they are actually paying the short sellers to hold their bearish bets.
So longs are paying shorts now. That's a massive shift in market structure, in sentiment, signals extreme caution, maybe further downside.
Potentially, yeah. It's a very strong signal. And let's just elaborate briefly on that yen carry trade unwind comparison. Why is that specific event relevant here?
Yeah, good question.
Well, the yen carry trade unwind, that was a sophisticated global macro event. Investors borrowed low-interest yen to invest in higher-yielding assets all over the world.
Right.
When risk perceptions suddenly changed, or if the yen started appreciating unexpectedly, these highly leveraged macro positions just collapsed instantly, forcing rapid liquidation across tons of different markets.
Okay, I see the parallel.
So comparing the current negative crypto funding rate to that event suggests that not only is leverage high, but the type of liquidation occurring now is maybe more systemic. It's hitting sophisticated global macro players who are highly sensitive to changes in rates and risk appetite.
So it wasn't just like retail traders getting wiped out this time.
Likely not just retail, no. It feels like a more structural flush out.
Okay. So the crucial takeaway here for anyone interested in or already in the crypto space is risk management, right?
Yeah.
That $1.5 billion wipeout is just a stark, painful example of the dangers of over-leveraging.
Absolutely. Cannot be overstated. When momentum fades and that funding rate flips negative, leverage just multiplies losses instantly.
Yeah.
The importance of avoiding over-leveraging is paramount. When the market is euphoric, everyone tends to ignore risk. Feels like easy money.
Right. Up only.
Exactly. But when the correction comes, and it always does eventually, those who have maintained dry powder, cash ready to deploy, they're the only ones really able to survive these volatility spikes, or indeed maybe even take advantage of the discounted prices left behind by all those forced liquidations.
Keep some powder dry. Sage advice in volatile markets. It's really easy to get tunnel vision, isn't it? Just focusing on the Fed, focusing on crypto. But while all that was happening, several other major tectonic plates were shifting globally, highlighting these profound structural changes and really a stark contrast between narratives of risk and security.
Yeah, we definitely need to connect these dots because what we saw was a massive flight from leveraged risk in crypto, happening simultaneously with the pricing in of profound geopolitical risk in global supply chains and this huge rush towards tangible safe havens.
Okay, where do we start connecting?
Let's start with that geopolitical turf war, the one that threatens the very structure of global outsourcing. You mentioned it earlier, I think. The Trump administration's order requiring that truly massive $100,000 fee for H-1B applications.
$100,000 per application. That's huge.
It's a profound structural shock. This one single change threatens to just rewrite the rules for the entire Indian outsourcing industry, which is, a global business model built on labor arbitrage that has grown into a staggering $280 billion industry.
Wow.
This fee, which has to be paid up front, it immediately squeezes the profit margins of all the major Indian outsourcers.
So it impacts the behemoths like Tata Consultancy Services, Infosys, companies like that.
Absolutely. They rely heavily on the H-1B program to deploy tens of thousands of skilled engineers across American client sites, everywhere from Citigroup to Walmart. And yet both those companies' shares slid more than 3% just on this news, reflecting the immediate threat to their operating models.
So that $100,000 fee, it forces an immediate strategic decision for them, right?
Completely. The core of the outsourcing model, it relies on delivering skilled labor at a lower cost structure than domestic U.S. firms can offer. If the cost of just acquiring the visa rises so dramatically, it completely undermines that whole arbitrage model.
So what do they do?
Well, companies will be forced to rethink their entire global delivery strategy. It could potentially accelerate shifts towards, say, nearshoring in Latin America, or maybe dramatically increasing hiring of U.S.-based local talent, which is, of course, far more expensive.
It's a really profound shift. Highlights rising protectionist sentiments affecting the global movement of skilled labor, even as, trade talks in other sectors like that TikTok deal signal maybe a tentative easing. It feels like a highly contradictory administration approach to global engagement.
It does seem quite contradictory, yeah. And this structural repricing of labor risk, it happened at the exact same moment we saw a really symbolic, decades-long investment relationship come to an end. Warren Buffett's final exit from a Chinese champion.
Right. Warren Buffett's firm, Berkshire Hathaway, reportedly offloaded its entire final stake in the Chinese EV maker BYD Co.
Stock fell 3.4% immediately on that news.
And what's truly fascinating here is just the sheer length of that relationship. Buffett held that stock for more than 15 years, right? Having first bought shares way back in 2008.
15 years. That is loyalty that spans almost 2 decades. It really defines an entire era of American investment in Chinese growth stories.
Yeah.
The full offloading, it actually started back in mid-2022, but the final exit was just confirmed recently. And the core rationale, according to the source material we looked at, it was driven by growing concerns over BYD's ability to fend off competition amid what they called a destructive price war happening within China's domestic EV market.
A destructive price war. That language, it suggests really fundamental concerns about profitability, doesn't it? Even for a market leader like BYD, it's not just that competition is tough, it's that the pricing dynamics are eroding margins to maybe an unsustainable level.
Exactly. And when a titan like Buffett, known for his incredible patience, his long-term value investing philosophy, when he decides to exit a 15-year relationship entirely, the market reads that as a significant lack of confidence in the future profitability and stability of Chinese domestic competition, especially in those high-growth, often subsidized sectors like electric vehicles.
Okay, so this confluence of events, massive crypto liquidations, these structural shifts in global labor with the H-1B fee, Buffett's definitive China exit, it all seems to point toward a widespread flight from complex, geopolitical, or highly leveraged risk.
It really does. And the destination of that flight, it's strikingly clear. Physical safe havens.
Right. The contrast is just palpable, isn't it? While $1.5 billion of virtual assets were collapsing and forced selling, traditional hedges just soared. Gold powered to a new record high, spiking aggressively towards, almost $3,720 an ounce?
Almost $3,720, yeah.
Yeah.
Building on a run of 5 consecutive weekly gains already.
And it wasn't just gold, which, people often consider the ultimate monetary hedge. Silver also saw massive sustained interest. Year-to-date gains topping 50%.
Over 50%.
Yeah.
We saw huge volume spikes in the iShares, Silver Trust Options, SOV, confirming major inflows into physical assets, or at least proxies for them, not just paper bets.
So what's driving this strength in metals?
It's really a powerful confluence of supportive factors, and it ties directly back to our first segment, talking about the Fed.
Ah, okay. How so?
Well, the expectation of further Fed rate cuts, that drives down real interest rates. When real rates are low, or even negative, zero-yield assets like gold and silver become vastly more attractive relative to, say, bonds that pay interest.
Makes sense.
Then you combine this with reports of central banks globally bolstering their reserve holdings of gold. Plus, the ongoing geopolitical tensions like the H-1B shifts we discussed, the persistent China risk, and you just have a perfect environment for tangible assets to shine.
So investors are essentially saying, look, if the Fed is easing policy, maybe printing more dollars, I want hard, tangible assets, things that protect against potential currency debasement and all this geopolitical turmoil.
That's the classic playbook.
Yeah.
It's a classic reaction to monetary easing combined with rising global instability.
And we also see maybe one final point of caution looking at the wider global economy, specifically in Europe.
Yeah, that's right. The European Central Bank has noted that Eurozone consumers are apparently already cutting back on discretionary spending. And interestingly, moving away from U.S. goods specifically in anticipation of potential U.S. tariffs.
Wait, why are they cutting spending if, as I recall, they hold ample savings? Didn't they build up savings during the pandemic?
They did. Yeah, the source material notes that Eurozone consumers are indeed sitting on ample savings built up since the pandemic. So they have high spending power. However, the uncertainty over potential tariffs, particularly from the U.S., seems to have made them deeply cautious.
So they're cutting back before tariffs even hit.
Exactly. Cutting purchases on non-essential items preemptively. This really confirms that just the anticipation of tariffs alone is enough to dramatically alter cross-border consumption habits. It just shows a defensive, risk-averse posture pretty much globally right now. Whether you're a retail consumer in the Eurozone or a titan like Warren Buffett making strategic exits, everyone seems to be playing defense.
Wow. A lot to process there. #tag outro. Okay, what an immense stack of sources to process today. We've moved from the highest levels of monetary policy, structural geopolitical shifts, all the way down to massive liquidation events in crypto, all in the span of one discussion.
Yeah, it's a wild ride. To quickly recap the synthesis for everyone listening, first, Powell's words this week. They will either validate or seriously caution this euphoric market, especially with that sticky 2.9% PCE inflation data looming on Friday.
Right. Markets pricing perfection, data might deliver imperfection.
Persistent imperfection, yeah. Second, Oracle dramatically stepped into the geopolitical spotlight as the potential algorithm gatekeeper for TikTok. It's a deal fraught with legal, technical, political complexity, and it seems to rely on a very narrow technical loophole.
Stock market cheered, but the regulatory oversight, that's really just beginning.
Exactly. And finally, the crypto market got that brutal gravity check. $1.5 billion in leveraged positions liquidated. A powerful, highly visual reminder of the extreme risks when momentum shifts and those funding rates flip negative.
And simultaneously, we noted those structural shifts. H-1B visa changes threatening global labor models, Buffett's definitive exit from BYD, all while physical safe havens like gold and silver just rocketed to record highs.
Right. Which brings us to our final provocative thought. Something for you to mull over.
Okay, let's hear it.
Look at the contrasting narratives here in Investor Trust. We have this massive flight from leveraged, volatile, innovative positions in crypto.
Yeah.
And a simultaneous record-setting rush into physical, tangible havens like gold and silver. What does this divergence really tell you about the investor mindset right now? Is this a vote against innovation? Or is it simply a deep-seated loss of trust in, say, fiat currency and monetary policy effectiveness, especially amidst a period where central banks are clearly signaling rapid monetary easing?
It's a profound question, really. Where does stability truly reside in the modern financial system? Innovation or tangibility?
Food for thought indeed. Our advice, stay nimble, stay hedged, and always remember, markets don't owe you a trend.
Well said. And just the usual reminder, this deep dive is for education and entertainment purposes only. It is definitely not financial advice. Always do your own research or consult a licensed advisor before trading.